Thank you for joining us again. We're at the Nigerian Stock Exchange, the trading floor, as we'll take a look at the market. But this time around, we'll be focusing on surviving uncertainties in a volatile market, especially in during a political and electioneering process like this. Of course, it's not news that election has been postponed, but definitely the impact of that postponement is what we're looking at in the market. And joining me to look at these is Mr. Tajuddin Olainka, who is also a dealer and a trader at Vamos Securities. Thank you so much for your time on the show. Let's get to talking about these uncertainties and volatility. First, the postponement of election, how did they affect the mood of the market? So perhaps you need to give us that impression.
Naturally, market had, given signal of uncertainty around the polity, especially the election that was coming. So market was trending down, up to a point that market now said, okay, even elections will come, it may not come, or something will happen, but the results are also coming. So market recovered slightly to align itself with expectation of results. But in the moment the elections were postponed, the market now say, oh, this political risk was actually a reality. The market reacted against that uncertainty. So what we saw yesterday was a reaction against that announcement that, okay, no, election will be postponed. It won't take place as scheduled. So the rescheduled election affected the market today. Uncertainty, market will naturally react. But again, before then, market had moved up, recover from the previous losses, and that was because the elections itself coincided with the results that were coming. The performance of the companies, the listed companies and all those stuff. So market was recovering ahead of the election based on that result. So the moment the political risk also realized is ugly head, market also reacted against that. So that was why we saw that very large level of volatility.
But how volatile can the markets be in a situation like this?
Well, anytime there's a signal of uncertainty, market will react. But should market react, at a high level of volatility? It shouldn't, because it shouldn't. And what is making that to happen is that market itself has its own structure. The moment that structure, maybe part of the structure, is not responding well, then you tend to see more volatility. Market should have small volatility, not a wide one. Not a wide one. But what we have seen in the not just because of this election, even before the announcement of election, the postponement of election, we have seen that. So market shouldn't be reacting that way. It's just because that certain part of that structure have not been responding well, and that structure means that there have been no strong presence of liquidity providers in the market, and so that allow market to behave that way. If liquidity providers have been in place, such as market makers and margin traders, we won't see much of that. But why we are seeing much volatility is just because those key players are not there, and the people who seem to be stronger than others now rubbing on the fragile ones.
So a number of factors, are some of the things that can be responsible for volatility in the market. Before we go to discussing how to take position and how to navigate this volatile market, I want us to discuss, you made mention of market movers and market makers. Yes. Could you break down what is really the role of these market makers, and how does it work, the process of ensuring that it works? So perhaps you need to break it down for us.
Market makers are specialists. They are specialists in the market. Just like other brokers, they do much more than just stock trading. They serve as interface between the market and the brokers. So they don't deal directly with clients. They just deal directly with brokers. Now, they are there to make a two-way quote. The two-way quotes that say, I'm buying at this price, I'm selling at this price, and there's a spread that they're allowed to make. Within that spread, inform what they think the fair value of security should be.
All right.
So because of the fact that these people, these specialists trade based on research, they almost will not get anything wrong. So markets usually rely on them. In other very big markets, you have them there. They are the ones that allow market to stabilize. So when you see their quotes, you know that they are signaling to the market that yes, we feel that the price of this security should over around this.
So their work is in form of projection, isn't it?
Yes,
projection and analysis.
Yes, to project what they think the fair value of those securities should be.
Okay.
So they do that, through their two-way quotes. Okay. If they do it wrongly, market will penalize them. How does that happen? If they are situating their quotes outside what the research has informed them,
that's right,
then market will be hitting them wrongly and they will be losing money. If they situate their quotes rightly and fairly well, the market will support them and they will help to stabilize the market. So their job is quite significant and it's very important to any market. So the level we have now, they are not playing that role.
Okay.
That's because they also don't have capacity to play that role. So that's the reason. We have them, but they are not playing that role.
Do they also have to take up the responsibility of dictating how the market should go most times? In terms of how a particular stock or share, the value of a particular stock should go or shares?
Yes, that was what I said earlier. They project the fair value of securities, based on their research. And based on their research, they're able to come up with two-way quotes. Okay. I'm buying at this price, I'm selling at this price. Bid and offer. Market look at that price and say, oh yes, this is justified.
Based on the value of that particular stock.
Particular stock, yes. But if market agree with them, market will trade around that level. If market does not agree with them, market will ignore them and begin to penalize them because they see that the market can see that they haven't done their research very well. They haven't done their pricing very well. And you see, let me say this: when we are trading securities, what are we trading? We are trading cash flows. Okay. Sometimes those cash flows are known, and sometimes those cash flows are not known. For some securities, the cash flows are known, and that's for the fixed income. Fixed income securities, you know that coupon will be paid to you on annual basis or semi-annual basis or on quarterly basis, and so you can discount those cash flows to its present value.
Okay.
Based on your own preferred.
If it is too high, perhaps.
No, you know. I'm not looking at cash flows that are certain.
Okay.
For instance, look at fixed income securities. If I buy bond, I know that they will pay me coupon, either on quarterly or half-yearly basis or annual basis. I can know what, if I want to trade that securities based on my own preferred yield, I can know what the value of that security should be today. Okay. But when you are trading equity, it's a different ball game.
Different thing.
The cash flow is not known. It's not so certain, but it can be projected. You can forecast it based on the performance of that company in the past. Now,
so it depends on the understanding and the knowledge base of an investor to invest in such.
Exactly. So the investor is trading, for instance, if I'm trading equity, what I'm trading there is earnings and earnings prospect. Okay. What the company will earn today, what it has earned so far, and what it will earn in future. Okay. That's why usually they send results, quarterly results, so that you bid on these results to be able to project what their full year will be. So when I see markets behaving irrationally outside what the companies themselves have posted, then I begin to wonder, should markets trend this way? That's why you see all this volatility. Sometimes uninformed traders come in and lead the market. When uninformed traders lead the market, they create that problem. But when you have a well-informed or a specialist leading the market, like market makers, you won't have that kind of volatility, because they are playing according to the rules. That they understand what the full year of that company will be based on their research, and so they now begin to estimate what the fair value or fair price of that security should be.
So that brings me to the very focus of the issue. I mean, what we're looking at, that when there is a volatility and that volatility is high, at that level in the market. So how do you think investors can use numbers, put these numbers together, looking at the fair values or perhaps projections by the market makers to trade or perhaps to position itself in a volatile market?
Yeah, if you trade based on fundamentals, when I say fundamentals, based on what is happening in the economy, how the economy can affect that company or those listed companies, how the economy, how the listed companies can perform so that their securities can be properly priced. Now, if you have done your analysis, your analysis will suggest a fair value to you. I think this stock should trade at X naira. Now, if I now see this stock trading at S minus whatever naira, you know that this is an opportunity for me. I have to buy. If the stock is trading above that price, trading at a value greater than X, then it means that if I buy that stock, I'm locked into that trade and I'll be able to get out quickly. Because the price is too high based on fundamental. So investors need to exercise some caution. But not many investors are so sophisticated to identify this. So what we advise is that when you don't understand this, especially if you are a retail trader, it's better either you allow investment advisor to lead you, you allow a broker to lead you, or you invest in a mutual fund. Okay. If you invest in a mutual fund, they understand all these things and they'll get this money for you. In fact, there are several other unit holders that will be part of that fund and will also benefit from their expertise. It's always good for retail investors to go through the route of mutual funds. But it's sophisticated investors like pension funds, like insurance companies, and all these big players who understand all this, and they can develop their own research. They have research departments that can do all these things for them. So for them, they know how to take advantage of the market. When prices are higher than your own, what you think the fair value should be, based on your own preferred yield, what you want to earn. That's right. Then it means that the thing has moved ahead of you. You wait until it goes, but normally market will correct itself. If it goes too high, if market makers are there and they are situating their codes, market has a way of correcting itself and bring it to that close to that fair value. And if a trend has, if a range of prices have been established, then somebody who does regular research can then take advantage of that. Okay, yes, this is my fair value, but market is not moving close to that value, but it has been trending along this line. Let me do it this way. If it's close to my fair value, I buy. When it moves higher up my fair value,
let's say your fair value is 250 kobo.
Yes, 250 kobo, for instance. Then and the price is 3 naira. I won't be able to buy. I want you to come close to that 250 kobo, or at worst 255 kobo. I can reach 5 kobo on it, or 10 kobo on it, 255 or 260. Now I'll wait for you to come down because that has been the range.
All right.
If it comes down to 255, I can buy it, even though it's 255 still above my fair value. But I know that it has never fallen to that my fair value in the last 1 year. I look at the last 1 year high and low, and I see that the high and low, none of them is close to my fair value. It means that I'm expecting to earn so much. So that's why my fair value is not in agreement with what the market is looking at.
So you have to wait as an investor for it to fall back to your fair value, the price of your fair value, before you can.
Because your fair value is dependent on your own preferred yield, what you want to earn. So once it gets to that level, you buy.
All right.
Or
that's the way an investor will
not lose money. Don't get carried away with what happens in the market. Don't get carried away with the noise in the market. Those movements are sometimes the noise in the market. Sometimes an uninformed trader will be the one leading the market, not necessarily because he thinks that the price is quoting for a particular security is the right price, but he just feels that let me just take it. I'm okay with that. He hasn't done any research.
That's right.
So market from time to time, market will correct itself by moving the price level below what that uninformed trader has set.
All right. I really want to hold your thoughts there. Let's quickly take a moment, and of course, by the time we'll come back, we'll talk more. We're still discussing how to survive uncertainties in the equities market. We'll take a moment now. We'll be back shortly. Do join us again. Glad to have you back now. We're still here at the Nigerian Stock Exchange looking at the markets and, of course, how to survive on uncertainties and the volatile market as an investor. So, Mr. Tajuddin Olayinka, dealer at Vermont Securities, is still here with me. Thank you for your time. Now, if you look at the market at the moment, would you say we are in a volatile market when you look at the Nigerian equities market?
Yeah, we are in a volatile market. Two things are responsible. The issue of political environment, the charge polity, elections, we are expecting elections to come. Now elections have been postponed. Yes, of course they will hold. Constitutionally, elections must hold. So market will still continue to react against those moments. But again, market, no matter what happened to the election, market has its own inherent values. Right. Those values will be upheld, and those values are the reason why you still see, in spite of whatever risk is associated with polity, market will still come around that values that have been upheld, and that's why you see traders coming around from time to time. Those values are still there, irrespective of what is happening in the polity. So let me go there and take advantage of that. So yes, volatility will be there. More so as a run-up to results that were being expected. Some of the results have been released. Those results, whether confirm whether the prices that the market moved up to were right or not. So if the prices are not, for instance, look at what happened in the case of Transcorp. Markets seem to have overpriced that stock at a point. And so today, it shares some weight.
All right.
So the same thing.
That's because that particular stock needs correction.
It needs correction, exactly. So it's correcting itself. So anytime there's overshooting, market will normally correct itself. So others, we are still expecting results on others. But the truth is that once you begin to see results like that, and some of them are not conforming, then market might now begin to react to say, okay, even the one that have not been released may not be so good or may not uphold the current price level for those securities. So let me also adjust. So you see market also correcting themselves even ahead of release of results of some other companies because of bandwagon effect. Investors thinking that even this one that are priced at this level, the result that came didn't justify it. So let me moderate my pricing of other securities that are so close to it. And so for that reason, you see some just small correction will take place until the final results are released.
So aside from the political atmosphere, Nigeria's political atmosphere, other factors responsible for the volatility, of course. Also it's part of that he has to correct himself. Okay, let's look at the earnings we are seeing in the market. Okay. How would you rate those earnings? Are they impressive enough to move any investor to take a decision in the market? If you look at each of these companies, of course, I'm aware that the like of Transcorp has released their result, and some other companies, a couple of companies as well, have released their result today.
So far, some of the results have been quite impressive, except, and I don't want to blame the result that was released by Nigerian Brewery. I said except Nigerian Brewery now. It's sending to release results today. Fantastic result. Transcorp also released results yesterday. Not too bad the result, but markets seem to be more interested in the dividend payout. Okay. 3 kobo to them was too low. In the past, even when they had less than that, they paid much more than 3 kobo. So why 3 kobo at this time? Fine. Company might want to retain.
The dividend they are paying is 3 kobo.
Yes, what the dividend they are paying is 3 kobo. And I think that is the reason market is reacting, trying to collect that price. That okay, even though you have improved on your earnings, but your payout is too poor. So we won't accept that. So market will correct itself against that. Even though what I think market should be looking at is more the earnings and not that dividend. Because the earnings, the part that is not paid out is retained to grow the business. So market can still value that. Market can still come back later and say, yes, even this company is not paying enough dividend. I can still hold on to this security because it has that value. That's right. So market might still, even though its price is going down, it might also recover later based on the earnings, not necessarily based on the dividend that the company is choosing to pay out. So, but let's look at it this way again. most of the results have been quite impressive. But if you look at Nigerian Bureau, it wasn't quite impressive. The performance beat my own imagination. But I don't know how other traders look at it. But the truth is that prior to release of that result, they had released quarterly results and market had priced them appropriately. It moved from over 150 naira or 150 naira to 80 naira or 70 something naira. And I think at that 70 something naira, it was a fair value for it. Market tried to move it above that 70 something naira to close to 80 something naira. And when the result was released, it shows that it should have been around that 70 something naira. So it's now correcting itself. It's coming back. So for that, it's okay. But for the irrational behavior of traders, prior to that result, I blame the market for it. That's why you see volatility. Why should price go beyond the fair value? Why should you take it when, even though we were expecting results? Why do you think the result, the full year result, will be much better than what you saw in the third quarter?
So these are the questions to ask
exactly.
when making a decision to buy into a particular company.
Exactly. You need to be sure that they have given you first, second, and third quarter results. You are just waiting for the full year result, just one quarter. Do you think any miracle will happen? And for that miracle to happen, it must come from the economy. Will the economy support that? Will the competition support that? It's not a monopoly. So what is happening? What is making the company not to be able to report or give you good earnings? So will the earnings change in that fourth quarter, which is for the full year? If it won't change, why then price it up? So sometimes you see, some of these big players taking advantage of the poor knowledge of others and rubbing on them. They move the price up just for them to take advantage of that price movement and drop it on them.
Okay, let me quickly ask you. Of course, you are a practitioner in the market. For a result, a company who has released its earnings into the market. So what would you advise an investor to look out for in these figures so as to make an informed decision when investing into a particular company? What is that particular things that they should look out for?
Yeah, first and foremost is to look at the turnover.
Okay.
You look at the turnover. If you look at it looks like turnover. If it's a manufacturing company. If it's a service company, you look at also their gross earnings. Okay. Like a bank and all those things, you look at their gross earnings. But when you look at that, you also look at the cost.
Is it a gross earning for a particular quarter or a gross earning in their annual report?
In the annual report. Of course, you can break it down to quarterly results, because the best way to project a company is to look at that quarterly performance, because you are not going to wait for annual result before you buy. You buy based on the quarterly result they have released. So you look at the quarterly result for this year, quarterly result for the previous years, and begin to project, to say, okay, based on the balance of probability, this is likely to be the direction of their full year result. Even when the full year result has not been released, you can run a model that tells you what the full year result will be. There are some very, very sophisticated models that you can use, like stochastic model. It will tell you, based on happenings in the economy and the environment of that business as well, every other thing, every other element in that environment of business, this is what I think this company will be able to do. So that thing is a probability model. It tells you plus or minus, this is the way, this is what the earnings should be. And if you know that the earnings should be like that, then what is my own preferred? What do I think is the risk element, even in holding that security? Then you now begin to discount it and get it through what the fair value should be. So basically, unless somebody is so sophisticated, you may not be able to run through this calculation, but you can depend on professional player. And from time to time, brokers also send out what they think fair value of securities will be for investors, to gain from it. Yeah, brokers do that.
Okay, let's look at, if you take out the uncertainties in the political environment, and of course the earnings that investors look forward to make an informed decision in the market. If you take out these two factors, so how would you also play in the market? If you take out these factors, what are the things to also look out for so as to go?
Of course,
yes.
Of course, you also look at liquidity level.
Okay.
If a stock is liquid, or the market itself is liquid, first stock has to be liquid before market can be liquid. If several stocks are liquid, the market is liquid. So you now look at liquidity of that stock. How often, for instance, if I'm buying a stock as a speculator, okay, I have to be sure that somebody is there to buy me out. when I need to get out of that security. So if I'm buying, for instance, I'm buying say 1 million units of a particular security, and that security itself hardly trade 100,000 units on daily basis. When do I think I can get out with 1 million units? So it shows that the stock is not as liquid as my determination. So it's a no-go area for me. So stock has to be liquid for you to also go into it, because of the fact that you are a speculator. But if you are somebody who is a long-term trader, who can afford to hold for a long time, and maybe you are trading because of income, you are trading because of the annual dividend that will come, then you may not bother about that, because you know the company is strong. Every fundamentals around the company is strong, and so you can still take those securities even if they are not so liquid. You know that even in future, if you need to get out, you can do it in piecemeal.
We do know that liquidity is an issue, just like you mentioned in your analysis. But as accessing, or perhaps accessing liquidity in the market, should it be something that perhaps, how do you think an investor can go around, liquidity, accessing liquidity in the market?
Yeah.
You talk about that.
The best way to look at it is look at the turnover. For instance, if I want to know how a company is liquid in a month, I can look at the turnover of that of that security in that month, and then look at the number, the share that they have as outstanding. So what I mean is that I can look at shares outstanding of that company, and look at the volume of those shares that were traded in that month. I can also look at it in a year. So that will give you, if you look at it on monthly basis, it will give you the movement, the liquidity movement of that security. But if you are looking at the market as a whole, then you have to look at the turnover of that market vis-a-vis the market capitalization. So once you understand that ratio, you know that that market is liquid this year, or it's less liquid this year, or it was liquid last year, it's less liquid this year. You then find out why did that happen? Because something must have caused that to happen. There were times that the market was extremely liquid in 2016 because of recession. So, and shortly after that, market became more liquid in 2017. Why? Because a window was introduced. So all those things, the moment they introduced investors and exporters foreign exchange window by CBN, that's on Forex, that encouraged foreign inflow to also come into the market and drive that liquidity. So we'll be looking at what new structures are coming up supporting liquidity. And so once you see that those structures are in place and are still driving liquidity, you can.
Okay, let's wrap up now. Going forward, of course, we do know that elections have been postponed, and of course we do know beyond elections the market which still exists. So going beyond election now, what do you see in terms of volatility and instability in the market? Are we going to continue to see this volatile market, or are we going to see a stable equities market?
We will continue to witness the volatility because the right structure is not yet in place. Until that right structure is in place, like I mentioned earlier, the market makers and of course margin traders. Okay. And once you have those, the market makers and those speculators
okay, these are part of the structure.
They are part of the structure. Yes. Once they are in place, you tend to see more liquidity support for the market, and you see less volatility. When they are in the market can't behave funny. It's when they are outside the market behave this way. So their presence is the presence of those two key players, liquidity providers and market makers, yes, margin traders, market makers, and also these big time players, the institutional players. Once they are there, it helps to stabilize the market. Their presence stabilize the market, and also checkmate the activities of foreign players who also most times also drive this volatility. The entry and exit also encourage volatility. I mean, I'm talking about the foreign players now. So once you have you must expect them from time to time. Once you have them, you also need to have the local capacity that can help to checkmate the activities. So that's the reason we have.
Well, let's leave it there. We must leave it there now.
Okay.
Thank you so much,
Thank you,
Mr. Tajuddin Olayinka, a dealer and of course a trader at Vamos Securities.
Thank you.
Thank you so much for your time.
Thank you.